right, let's talk about gold. You look at the prices, they're at all-time highs, and the first question that pops into your head is probably, is this stuff just way overpriced now? But the source material we're diving into today makes a really fascinating case for the exact opposite, that gold isn't just fairly priced, it might actually be a massive bargain. So let's dig in and see how they got there. So there it is, the big question. And let's be honest, you glance at a price chart and of course it seems expensive. That's a totally natural reaction. But the argument we're about to explore says that looking at the price alone, well, it's kind of like judging a book by its cover. To get the real story, we've got to go a lot deeper. And that deeper look? It starts right here with this one really critical distinction. The source material draws a hard line between two very different ideas, the market price and the intrinsic value. Now, the market price, that's simple, right? It's the number you see on the screen, what you pay for an ounce of gold today. But the intrinsic value? Oh, that's a whole different story. The source argues its true worth is tied to these huge economic forces, things like national debt and the stability of our money. According to the source, the entire case for gold being undervalued, it all hinges on this enormous gap, this great divide between the price on the screen and what they see as its real fundamental value. The argument is that what we see day to day just doesn't reflect the economic reality simmering under the surface. And what is that reality? Well, for starters, how about this number? $38 trillion. That's the US national debt right now. The source says that historically, gold's value gets a major rethink in moments of extreme debt like this. And yet today's price, as high as it seems, barely seems to notice this staggering figure. This is ground zero for that value gap. Okay, so that raises a big question, right? If this massive gap actually exists, why? Why doesn't the price just catch up to reality? Well, the source material points to three key factors that could explain this disconnect. Let's break them down. This is such a fascinating point. On one hand, you have the paper markets. These are the places that set the daily price that you and I see. And the source suggests these markets can keep the price artificially low. But then, on the other hand, you have the physical market, where huge players like central banks are quietly buying up enormous amounts of actual gold. What they're doing tells a very, very different story than what the daily price is saying. And this is exactly what we're talking about in real time. You've got central banks, and the People's Bank of China is a perfect example, actively moving their reserves away from the US dollar. And what are they buying instead? Millions and millions of ounces of physical gold bars. According to the source, this isn't just about balancing a portfolio. They're getting ready for a potential monetary reset, which signals they believe gold's real value is way, way higher than today's price. And you know what? This isn't some wild new idea. This has happened before. The source points right to history. Back in the 1930s, in the middle of the Great Depression, the US had to devalue the dollar against gold just to handle its debts. It happened again in the 1970s when the dollar was unpegged from gold and the price just exploded upwards. The argument is that today, with debt levels that blow those previous eras out of the water, we are standing at another one of those historic crossroads. And all of this leads us to the most forward-looking and, let's face it, the most speculative part of this whole argument, the theory of a future monetary reset. This is the event that proponents believe the central banks are preparing for, and it's the ultimate reason they see gold as so fundamentally undervalued. So what on earth is a monetary reset? Well, the source defines it as a moment of crisis. It's when a currency system, one built on a mountain of debt, starts to collapse. In that kind of scenario, the theory goes, the authorities would have no choice but to revalue gold at a much, much higher price. And why? Because gold is seen as the one asset that can restore people's faith and confidence when trust in paper money is completely gone. To really get your head around this, the source uses a brilliant analogy. Think of the global economy, with all its crushing debt, as a room that's on fire. Now, the current market price of gold, that's the thermometer in the room. But here's the catch. The thermometer has been put inside a cooler, so it's showing a nice, cool temperature. It's not representing the true heat of the room at all. The monetary reset, then, is the moment that cooler shatters, and the thermometer reading suddenly, violently skyrockets to show how hot the room actually is. So when you look at it through that lens, you get to this quote, which really sums up the whole perspective. For people who subscribe to this theory, obsessing over the day-to-day price of gold completely misses the point. The current price is just seen as an entry point, an opportunity to get a hold of a deeply undervalued asset before that thermometer finally breaks. And that leaves us with the final, provocative question that this whole analysis is built on.
We can see the smoke from the debt crisis, right? But the thermometer's reading, the price is still contained. The question isn't just whether the room is getting hotter, but if, or maybe when, that glass is going to break and the price of gold finally reflects the true heat.